Hey there, it's Jon Fleischman, and welcome to SoDoesItMatter.com, the podcast. And I'm very, very excited about this week's guest. But before we get into it, as you know, here at SoDoesItMatter.com, we're all California politics all of the time. And we do these straight talk podcasts to put you directly in touch with people that matter as we talk about California politics and necessarily California policy, which is what really is the main focus of California politics. It's public policy. So I have spent a lot of time on our page and on our podcasts talking about this new scheme that's been introduced, the billionaire wealth tax, as it's called, but I think it's more appropriately just labeled a billionaire taking. Right? It's a measure that seeks to take from people what they've already been taxed on and earned. That having been said, our guest today, I'm very excited, Josh Rauh of the Hoover Institution, which is located at Stanford University. You may know Hoover from its most prominent fellows, who I think the late George Shultz, of course, loomed large over at the Hoover Institution, and Condoleezza Rice still looms large over there, but they're missing the third piece of the crown, which is Josh, who is a economist there at the Hoover Institution. He's one of the country's leading economists on public finance, government debt, and long-term fiscal sustainability. He previously served as a principal economist with the White House Council of Economic Advisors, and his research on pension liabilities and fiscal risk have made him a key voice in debates over financial health of state and local governments. Wow, that's a really depressing conversation if you're talking about California state government, by the way. He's just completed a major new analysis examining the real-world impact of the proposed billionaire wealth tax taking thing that I was just talking about. And he's looking at it not just in theory, but what actually happens to investment, taxpayer behavior, and ultimately, what does this actually do for state revenues? It's an issue that's getting a lot of political attention, but not enough serious scrutiny. And when I say that, we're in an era that is unfortunately, and I say this as an influencer, dominated by X, dominated by Instagram, dominated by Facebook. And so what you get is a lot of analysis that is filled with hyperbole, filled with things that encourage you to click, but lack the depth, which, by the way, Josh, as I get ready to introduce you here after my little filibuster here, that's why this website is called So Does It Matter? Because we look at the things that matter, and our goal here is to move beyond the veneer, to move beyond the soundbite, and really dig in. So we're happy to have you with us today.
Thanks so much, John, and really appreciate that approach. I think it's so important. It's something we try to do in all of our work.
Well, we're going to talk about it. So are you coming to us live from Stanford University then?
Live from the Hoover Institution at Stanford University, yes, indeed.
I have to tell you, that's a very beautiful, beautiful place. I went to San Jose State for a couple of years, so I had some opportunities to go visit a campus. I went to a few games where it must be something to be at an institution where your school mascot is a tree,
The students make the most of it.
Yeah, exactly. So let's kind of dig into it. The first thing I'll say is if people watching this find this of interest, the thing that you could do to help the most is to spread the word about what's going on with this billionaire tax. So if you're watching this on Substack, restacking and liking are great things to do. If you're watching this on YouTube, subscribing to our channel, liking it, those things all help the infamous algorithm, which sounds like a joke, but it's true. The more things get liked, the more they get shared, and the more they get liked, the more they get shared. And it's the difference between whether 10,000 people are going to see this interview or 200,000 people. And so please do your part to help, and we really appreciate it. So with that having been said, our first segment, we kind of do this in segments, is what this tax really is. And I'd really like it if you could maybe explain to the people watching in plain English, what does this actually do, Josh?
Well, this tax is it's going to be on the ballot. They've raised more than enough signatures for it. Those signatures are being considered by the state government, but it's going to be on the ballot. And what it does is it takes 5% of the wealth of billionaires based on the way the proposal is written. It would be on a one-time basis, meaning it's a one-time take of net worth. This is very different from taxes that we've had in California, the United States. Really, we don't have a history of this here, because this is taxing somebody based not on the income that they earn, but on the assets that they've built up. And so what it would do is based on residency as of December 31st, 2025, so the end of last year, it would It would just assess whether or not a person is a resident of California and subject to the tax. And if they have more than $1 billion, then 5% of their assets, of their net worth, is owed to the state, and their assets are going to be measured as of the end of this year. So there's a retroactive aspect of this. If you're a resident here at the end of last year, and we assess that you have more than $1 billion by the time this proposition would pass in November, then we're taking 5%.
Right. So, and like you said, we don't have a history of this in this country because usually taxation is somehow associated with some sort of activity, whether it's you're buying a product and you're paying a sales tax, whether you're making money and you're paying income on it. There's other examples, but usually at the end of the day, you're able to kind of say to yourself, okay, I've now made this money, I've paid my taxes, this is what I have left. So this is really the first time that I can think of where there's a serious proposal to say, but we're not done with you yet. We actually think that maybe you made too much, and we're going to come and we're going to kind of take it. Supporters are calling this a one-time 5% tax on billionaires, but that's not entirely accurate, is it?
It's not entirely accurate. If you look at what the tax, what the provision actually does, in order to get this implemented, it requires changing the Constitution of the state of California. Constitution of the state of California has limits built into it as to the extent to which the state can tax individuals based on tangible assets and based on intangible assets. Actually, everybody knows about Prop 13, the ballot proposition 1978 that limits the extent to which the state can impose property taxes on us. State or local governments can impose property taxes on us. There was also a ballot proposition a couple of years before that limited the extent to which state and local governments could implement taxes on intangible assets. So, meaning stocks and bonds, financial wealth. And so in order to get around that, this proposition has to actually change the Constitution. And in doing so, it sets up an architecture that would make it much easier for such taxes to be repeated in the future. And there are a couple ways that could happen. One is that any ballot proposition that would come up in the future to implement more wealth taxes would be basically much simpler because the constitutional architecture is already there. People would just be voting to sort of do this again. It's not a very complicated ballot proposition. It wouldn't be hard to summarize. The architecture is already there. The other way, potentially, that there's an opening for this is there's a very worrisome paragraph in the initiative as written that gives the legislature some leeway to potentially change terms of the measure. Now, we don't really know what that's going to entail. I'm not a constitutional law expert, but I've read the entire initiative many, many times. And whenever I read that paragraph, I just wonder to myself, would this be the kind of thing that would allow the legislature, a future incarnation of the legislature, to say, we're just going to repeat this again? Or would it be something that would even allow them to basically cross out the word billionaire and write the word millionaire? We don't really know how this is going to play out in terms of what can happen going forward. But one thing we do know is that the way that the targeted taxpayers, billionaires in California, have responded to this proposal suggests that they do not think it's going to be one time.
I would say this as we do the political overlay to the policy, because I think you've brought up what I think is a very alarming provision that's within the measure. The final arbiter about what that language actually means is not the United States Supreme Court, where I guess a fiscal conservative could rely on, at least right now, a conservative majority. It would be the California State Supreme Court. And this is a California State Supreme Court that has demonstrated over the last few years, especially, a penchant for partisanship and a penchant for activism that would have me very, very worried that if there's a section in there that is ambiguous, that the ruling is going to be, kind of for the collective growth of government. So I think you're right to bring that up as a concern, and people watching, when you're talking to people about this measure, it's absolutely important that you make sure that they know that there's language in this measure, and it's not there by accident. There's language in this measure that gives them at least wiggle room, if not a wide open chasm for this to be either repeated back to the same billionaires over again, or like Josh said, for the scope of it to expand. And they may decide that tomorrow, you know what, we need to go after people that are millionaires. And by the way, that's a lot of people in California have property that makes them a millionaire. It's not like this is the 1920s and millionaires was something that like that's crazy. So I want to move on to something that I think is really novel and very important in your research that I've not really seen anywhere else. You actually dig as an economist to talk about how much this measure would likely actually raise versus what they're claiming it would raise, you know. So maybe you could talk to us about that because they're saying it could raise like $100 billion. And based on what I read from your report, which yes, I read your report in advance of this, you think that's pie in the sky. So can you talk about that?
That's right. And as with any measure for a tax increase, one of the main arguments of the proponents for the tax increase is this will raise a lot of money, and they argue that this is money that will be substantial amount and that is money that the state needs. So as part of the justification for this tax, the proponents have gone out and they are arguing that the tax will raise $100 billion, as you said. But what is that number based on? Well, a lot of our research goes in and tries to take a look at that. Where does that number come from? And what are some other sort of margins that have not maybe been considered when they put that number out there? So first place that it comes from is they went to the Forbes list of billionaires, and Forbes does actually a really good job of trying to figure out who all the billionaires are in the country and the world, and tries to estimate their net worth every year. So they started with that, and they said, all right, we think the state is going to take 5% of the billionaires on that list who have a residence in California. Now, so that got them to about 110 billion, and then they assumed that there would be about a 10% leakage of some kind. There would be some sort of avoidance or evasion that would maybe reduce
Some
that number
sort.
by 10. Yeah, exactly. So you get to 100 billion. Now, we took the first thing we did was took a very, very close look at just that very simple calculation. And one of the major gaps in their analysis, one major thing they missed is that there's one individual, Larry Ellison, known to be the CEO of Oracle for many years. And Larry Ellison left California in 2020, moved to Hawaii, and then later he moved to Florida. He has not been a resident here for quite some time. Yet they included him in their estimates. And you might say, well, one guy, no big deal. Okay, well, Larry Ellison is worth $217 billion. So 5% of that, is a pretty substantial amount. So now you're talking about $12 billion on the of tax take just on that guy. So that there goes their 10% right away just because they misclassified one person. So you like start there, they missed one major person who's no longer resident. But then if you've been following the news on this, there are a number of people who established residence elsewhere in the country between the time that it was reported that this initiative was brewing and had been sent in to meet various regulatory deadlines, and the December 1st, 2025 cutoff date. Among those are Brin and Page, the founders of Google. These gentlemen are also worth very, very large amounts of money in the hundreds of billions of dollars. And so they've left. They're gone. Several other people have also been reported to have left before the December 31st, 2025 deadline, have been confirmed by the media to have left. And so when you just account for those people, you're actually all the way down to 67 billion just as a starting point. All right. So we've already just reading the news about who's left, we've already chipped away, about a third of their estimated tax take. That's not the end of the story. After that, right? So of the 212 Forbes California billionaires, it's very, very likely that a pretty substantial number of additional ones were following the lead of some of the others at the top and also leaving the state of California. I mean, Jensen Huang has said he's sticking around, but there are many others who it may not have been reported in the news, but they left. And in addition, Mark Zuckerberg, he established residence in Miami in February 2020.
Yeah, I also saw the guy the CEO of Uber has moved to Texas.
The proponents are saying that's too late. We're still going to catch them in our dragnet, if you will.
I think this whole retroactivity piece has some constitutional questions to it.
That's going to have legal and constitutional questions. So when you account for all of these things and the fact that others have left maybe late after the deadline, but it's going to be challenged, or there's many people who are not reported in the press when they move residence, we estimate pretty generously that there's a ceiling on that wealth tax take of around $40 billion. And there's much more as well. But I don't know what.
Right. And I would say Josh, this is an odd circumstance for me because I've been writing about this and because they're engaged. I've now actually been able to speak to not one, not two, not three or four, but five billionaires who are very consciously focused on this issue in some measure, trying to do something to try to stop it. And all of them believe that there's no way that this is a one time pass, and that all of them were aware of this provision that you talked about in the measure that would allow in their opinion, in their lawyer's opinion, the opportunity for the legislature to simply go, that worked out pretty well. We're going to do it next year and the next year and the next year. And it's just going to be kind of a permanent feature.
Well, it seems like in California, there's literally no such thing as a temporary tax. And how do we know this? I mean, if we look at Proposition 30 in 2012 that implemented those higher tax brackets for the income tax, 10.3%, 11.3%, 12.3% top bracket rate, plus the 1% millionaires tax brings the top tax bracket for the income tax up to 13.3% in California. That was a temporary measure in 2012 that was supposed to expire in 2018. Then in 2016, we had Prop 55, which extended that to 2030. Happening now, this has fallen under the radar, John, because people are focusing on the wealth tax. But the
This one's also
California Teachers
making
Association,
it permanent.
the California Teachers Association has just announced we got the signatures to get that on the ballot this November to make that thing permanent. So that's also going to be on the ballot this year, making the 13.3% top
Well, and
marginal tax rate.
I think as somebody who studies politics, I would tell you that I almost wonder what the California Teachers Association, who has not endorsed the billionaire tax, I wonder if they're concerned because, you put too many tax increases on the ballot and you're going to end up really creating an impetus for voters to be anti-tax. And all of a sudden, they're voting no on all the taxes, even though they may think the extension, it's for education, it's for our kids, right? Maybe that extension would do better, but wouldn't it be ironic if the billionaire measure from the greedy healthcare workers union pulled down the permanent extension? We may be able to give a taxpayer champion award to SEIU healthcare workers at the end of the year, I hope, for best supporting actor in defeating a permanent tax extension on this income tax. But we'll
That's
see.
a great point. I mean, if you overreach and too many tax increases are on the ballot, some of them get threatened. I think the wealth tax is earmarked 90% for healthcare, and that is related to the fact that an SEIU related healthcare related entity sponsor. I think the California Teachers Association was worried that they weren't going to get enough of their piece of the action there, and that's why I think they pushed this year very hard to be the year that the income tax extension is going to be on there. But I think you're right. I think this could be some very serious overreach that they could threaten both of the measures.
So, and when I was reading through your report, I saw this and I had to kind of figure out what it meant. So I'm going to have you try to explain it to our readers. You found that 71% of modeled scenarios produce a negative net present value. Why don't you explain what that means, that finding? Because I think it's interesting.
Okay, well, let's pick it up from, the proponents said the wealth tax is going to raise $100 billion. We said even just on the people who left, plus some pretty basic modeling about, who else might have departed. Just for the people who left, you're down to a ceiling of $67 billion. Assuming also that some others got out who weren't reported in the press. We got a ceiling of $40 billion. What about after that? Okay, well, those people who leave, they also take their income tax revenue with them. California can no longer tax their income if they've established residence someplace else. And that's a not just a 1 year thing, but that's their income year by year after year after year.
So basically, even if this measure fails, the billionaires that left in anticipation of the measure are now going to put a massive deepened structural hole in the state budget because they've left. As somebody reminded me, you can make all the investments that you want while you live in California, but if you're not a California resident when you sell those investments, then California gets no capital gains whatsoever.
Correct. California taxes capital gains at that top ordinary rate, which is going to be 13.3% for these individuals. And so basically, all of the economics jargon that you tossed out there is basically just asking the question. All right, we have this $40 billion ceiling starting point of how much the state would make from the wealth tax. How much of that is going to be offset by losses from the income tax? And it's just a matter of model scenarios question. How do you kind of translate that expected income tax loss into an apples to apples number against the $40 billion? And, on average, it would be around a $65 billion net loss for the state if you can translate that stream of future cash flows into a one-time amount, getting us to a central scenario of about negative 25 billion. So that's why we say the net present value of the wealth tax is negative 25 billion. That's what it's going to cost the state of California in present value terms, $25 billion out the door. And that's really also just a very, very narrow picture, because it doesn't consider the jobs that these individuals are going to bring with them, the lost revenue from that.
Yeah,
And
how
it
long?
doesn't consider what's going to happen to the state if, Silicon Valley is no longer the hub of innovation, if, Austin and Miami become
Yeah.
places where young people want to
I
start companies.
I have seen this happen. I have friends who are business owners who have moved to Texas, and specifically in this case, 3 of them. And they move out there and it starts with them, "Well, I've moved to Texas, but I'm flying out, every other week to be at my corporate headquarters." And then, by 5 years later, they have offered relocation packages and moved their entire companies to Texas because they found out, wow, it's like we're gonna leave Kansas and go to Oz where everything is in color. And so at the risk, and I apologize to people watching this because I've got a little more of a wonky hole I want to go down with the economist, and we're going to try to keep this at a level that everyone can kind of understand. But I want to talk about what I'm calling the founder control problem, because that was, or maybe you called it that, right? So in your analysis, your later analysis, I think I may have seen this on Substack actually, or maybe that's where I read it more in depth. But there's this issue of voting control and dual class shares. What is that? And how does it, I think it has to do with valuation, right? And how if this new Department of Wealth Collection from the state of California comes knocking on, I don't know if it's Page or Brin or Zuckerberg, or maybe one of the people didn't leave. How would this work? And then I guess the add-on question would be, how could you be taxed for more than the wealth you actually have? Because that's also part of it.
Yeah, it's a great question. We did write about it on our on my Substack, the fiscal reality check. So I'll do a quick plug for that one.
You can plug it, and we're also going to have a link to that right below here. All the places where they can get your great works are linked right below this, or if you're on YouTube, it'll be in the show notes. So our
Okay, good.
goal
So the
is to,
first thing your listeners will do will be to make sure they're subscribed to So Does It Matter. But the second one should be a check out the fiscal reality check, because that's where we do really the play by play on this, and where you can get the latest on this topic. So yeah, the founder control. I mean, this is both as from an economist perspective, it's very interesting, but as somebody who cares about the state of California and public policy, it's frankly very terrifying, because as you say, it's a way for the state to really say, we're going to tax you as though your wealth were more than what your net worth actually is. So how can that happen? Well, and let me just say, like, a really basic way to understand how it might happen is, this happens less in California, given Prop 13, but there are other states of the country where people face property taxes on their real estate, and they're in situations where their county is basically saying that their property is worth a lot more than it actually is. And so then they end up they're paying property tax based on like an inflated valuation. That's kind of what's going on here with the founder control issue, which is that there are provisions in this initiative that allow the state to revalue the wealth of someone. You can think of it as inflate the stated value of the wealth of someone, based not on the percentage of the shares of the company that they own, but the percentage of the company that they control. And you may ask, well, how could that be different, right? I mean, if I own 40% of the company, don't I control 40% of the votes? Well, not in all corporate structures, and actually in many companies like Alphabet and Meta, many of these tech companies owned by the targeted individuals in this measure, they have two classes of shares. They have one that's the rights to the cash flows of the company, and the other that's the rights to the voting of the company. That allows them to keep control of the
yeah,
company's decisions,
while selling
without
equity to investors, right? Getting more
exactly, and
money
also
to
give equity to
capitalize
investors.
the company.
Exactly right.
So you could literally have somebody who, say, owns 15% of a company, but retains 51% of the voting shares, being taxed on 1% of the value of a company. As a matter of
Exactly.
fact, you could be sure that would happen under this measure.
Yeah, right. Well, so like you could take Mark Zuckerberg as an example, right? So Mark Zuckerberg owns 11% of the cash flow rights in Meta, but he's got 61% control. So what this provision would allow would be for the state to say, actually, you're not worth the 200 billion that's implied by how Forbes or how any normal person would think about your net worth. You're actually worth $1 trillion, and we're going to tax you based on that, which would require people like Zuckerberg and Brennan Page, as well. They left.
They'd have to start liquidating shares. They'd have to, because they're not, nobody has that much liquidity. Nobody's sitting around with that much money in their bank account.
Exactly. They're going to be they would have to sell. They'd have to liquidate shares. That would have big impacts, by the way, for anybody who owns these companies in their 401k, because it doesn't happen without any price impact. So that's a really now just so the it's interesting. The drafters of this provision, they have responded to concerns about this by saying, well, that's actually not our intent. Well, you know what? It doesn't matter what your intent is. The initiative text is what it is, and it gives the initiative gives the bureaucrats at the Franchise Tax Board, our State Department of Revenue, and ultimately the California Supreme Court, the right to interpret the initiative in the text. And if you read what the text says, it sure looks to me as though this would be applicable to companies like Meta and Alphabet. The drafters out so we only meant this to be applied to certain private companies. Well, I mean, I don't know. You may have meant it that way, but your text says something else.
Yeah, it's pretty crazy. So I guess I would ask you this. We're going to close this up pretty quick here because I have found that we're at about the sweet spot where people will pay attention and focus and take these arguments with them. But if you had a minute or two with a voter, let's say you're at the Palo Alto Gelson's or whatever, or maybe a Whole Foods, trying to think of what the foodie place is that everyone goes over there, or better yet, you took a stroll into East Palo Alto and went to Ralph's or whatever, and somebody comes up to you and says, "Hey, I recognize you, Josh. You were on the So Does It Matter podcast, which I love. I'm not a billionaire. Can you explain to me in a minute or two why I should vote no so that I can tell other people to vote no?" What would you say is your elevator pitch on why this is a bad idea? I know it's, so by the way, it's risky to ask a Hoover Institution economist to boil down a message into a minute or two, but we're going to try to do that and we'll see if it
Look,
works.
this measure is trying to squeeze some money out of very wealthy business founders right now. They don't care if that leads to the destruction of hundreds of thousands of jobs, which it very well might. So, do you really think it's worth it for them to try to do that when it's going to it's going to threaten the economy? I mean, the reason that we have employment here in this area, and the reason that there are robust opportunities for a lot of people, is because we have the jobs here. Want that job to go someplace else, then then vote for this measure. If you want to keep the thing strong here, then don't. One of the proponents of this measure basically admitted to me on stage that he'd be happy pretty much liquidating Silicon Valley if he could bring in $1 or $2 billion a year from a tax, which is just pocket change for a state that brings in $300 billion. People who write these measures and they never consider what the impact is going to be on just the regular person. They're only thinking about how can we bring in more revenue for the state. And so, if you care about the economy, you care about jobs here, then you got to vote no on this.
Yeah, I guess I would just add to that, Josh, for the cynical voter, if you think that what money does come in from this measure that ends up in the hands of the California state legislature is going to end up going into something that helps you as the average person on the street in California, you've got another thing coming. California government there's a corrupt game that takes place where the public employee unions get the public policymakers to raise taxes, and the lion's share of the money just goes to enrich the members of the public employee union. So if you're not a public employee, this measure is really not about you. This is about taxing billionaires to grow the size of the state workforce and give them all more pay and more compensation, because that's what it's always about.
Exactly
So
right. Plus, this tax is probably is coming for the rest of us, because once they establish that they can tax assets, if you have any assets, you're going to think about how you're going to want to hold on to them, because once that structure is in place, it can be extended to anybody at any time.
Professor, with that final note, I wanted to say thank you. But, I did want to ask you to do one last thing before we ended this main interview. I didn't really give you a chance to give at least a little talk about the Hoover Institution and what it does. And I don't need to hear later from Raul or from Bill that I didn't give you an opportunity to plug the institution, even if it's here at the very end of the interview. So can you tell us about this storied institution?
Absolutely. The Hoover Institution is a think tank, public policy research think tank that sits at Stanford University. It's actually an integral part of Stanford University. I mean, the iconic Hoover Tower, okay, that's part of the Hoover Institution. It's right in the middle of campus. And what we do is we try to bring rigorous analysis to public policy that is really at the level of the highest quality publishable research, and use that to inform recommendations that we may make to make to policymakers. So it's really a terrific and storied institution with an amazing set of others here that I interact with on a daily basis. And so we cover the gamut of topics from economics to U.S. politics, international affairs, and history. We have amazing historians here as well. So interpreting history and interpreting current events in the light of history. But really, I'm honored to be part of this place every day.
That's great. Well, we will make sure to include some links below so that people can explore the Hoover Institution. And while this is actually almost a year into me doing this particular website, this is my first time interviewing somebody from the institution, but it won't be the last. This has been great. I really, really appreciate it. And I'm sure, be talking to you again before we get to November with this billionaire wealth confiscation tax being on the ballot. So thanks, Josh. Really appreciate it.
Thanks so much, Sean.